bring us up to speed on this bond auction today. What were market expectations and how did that pan out?
Okay, markets, just like you earlier said, the bond auction was, it was expected that they will offer 90 billion today for different maturities, 2023, 2025, and 2028. And each of them is supposed to have 30 billion. Rates are expected to go lower, especially for the 2023, which is a new issue. It is expected that rates should close between 12.70 and 12.75. For the 2025 maturity, 12.75 to 12.7 to 85, and then for the 2028, 12.85 to 13.00.
Okay, so I want to switch slightly to another fixed income instrument. I want to switch to T-bills. Over the past couple of days this week, we've seen T-bills yield trend quite low. What's your outlook for them for the rest of the week? Do you see a resurgence?
No, we do not expect a resurgence in the Treasury bill rate because the market is awash with liquidity, and then most people are actually waiting for next week's auction, which will be coming up on the 3rd of May. They expect market to go up from next week, and then they can now re-enter.
Now, Emmanuel, I'd like to hear your thoughts on what we're seeing happening on the global front. I'm sure you're probably aware that U.S. 10-year Treasury bond is now at 3%. But I know that that usually has an impact on emerging market portfolio managers looking to where to get the best returns. For a market like Nigeria, even though we're down at somewhere between 12 and 13%, that's still attractive. But for the U.S. 10-year bond at 13% or just above 13%, what does that mean for the market?
For the U.S. bond that is trading above 3% today,
3%, yes.
3% today, it should be expected that should have an effect on the emerging market. But still, the yields on emerging markets are still high. Take, for example, Nigeria, yields trading between 11 to 12% is still high relative to the 3%, which is being traded on the U.S. market. Now, most investors look at average emerging market inflation rate, which is below 3% at present, which is at the record low. So we did not expect a significant negative effect of U.S. Treasury bonds on investments in emerging markets.
Now let's jump across the pond to Europe. I know that the European Central Bank is set to have a Monetary Policy Committee meeting tomorrow. What impact do you think this could have on emerging markets and Nigeria's fixed income market as well?
Okay, the market is already pricing in a cautious tone from the European Central Bank. They expect that Draghi should sound dovish, and then that will kind of have a tolling effect on euro. But by and large, that should not have much effect on emerging market currencies or securities at all.
Well, what do you think will be the factors that will continue to dominate, the market for the rest of the week, impacting on demand-supply dynamics?
Sorry, can you repeat?
What is your outlook for the rest of the week for the bonds and the fixed income market in terms of yield? We're seeing yields at around between 12 and 13%. Is this going to be the status quo for the rest of the week? Yes,
we expect it to be status quo, added to the fact that there will be FAC payments this week. There are also T-bills maturities, and coupled with the fact that the market is awash with liquidity. So we expect markets to remain low.
Okay, so we've got the next MPC meeting next month. What are your expectations? Are you expecting a drop, or are you expecting a conservative hold again?
We expect Central Bank of Nigeria to keep rates on hold. That is MPR to remain at 14%. All other things remaining constant.
You don't think the market is expecting some, perhaps a tweak to perhaps maybe the cash reserve ratio or some kind of signal that the central bank is or has acknowledged the fact that some of its policies are working? Inflation, for instance, we're seeing that trending lower, and that it might be time to signal a rate cut?
No, considering the fact that rates have already gone lower in terms of securities, and also coupled with the fact that we have political events coming up later in the year, the central bank will not want to add some shock in the market. So because of those two reasons, rates are expected to remain the same. We expect CBN to keep rates at the levels they are presently.